So I would like to start by thanking the organizers for having me included in this program. There is, as you can see, there is a huge audience here with diverse backgrounds, so it's very hard to involve too much domain knowledge. I'm going to try my best to focus on the statistics and to talk more about the interesting part that we all care about. So this is joint work with Yassine Sahalia, who is an economist at Princeton University. And as the title suggests, we're going to focus on covariance matrix estimation with high frequency data. So high frequency data refers to the transaction level data for stock returns. So hopefully they meet the criterion of more than massive data for this conference. So let me start with the motivation. Economic theories predict that assets earn risk premium because they are exposed to risk factors. And the co-movement between assets is driven by their exposure to those common risk factors. So in the literature, much effort has been devoted to searching for observable empirical proxies for the factors. And using these factors, in practice, the covariance matrix provided by Barra, for example, has been the industry standard for decades. So it's probably, you guys probably know this already. Barra was actually founded here in Berkeley by some finance professors, in 1970s. So however, the methodologies that rely on daily historical data are developed when markets were, at least by modern standards, more quant than quant. So a long time span is required for estimation. So as you can imagine, the factors that were important in 2008, such as housing prices, are no longer important, or at least not that important nowadays. So the factors might change over time. So therefore, covariance matrix based on low frequency data may adjust very slowly to the time varying investment opportunities. So moreover, daily returns may not be informative enough about the risk. So here is a picture about S&P 500 index on 2008, October 10th. So this is the intraday transaction price for S&P 500 index. So as you can see, the index dropped at the beginning from 900 to 840 and increases to as high as 940, which is 10% within the day, and ended up around 900. So if you're using daily return only, so you're going to end up with a daily return, which is less than 1%, which is certainly an underestimate of the huge risk within this day. So if you measure the volatility for this day using intraday data, you can find that the volatility for this day is actually historically high. It's actually over 100%, extremely high volatility. But using daily returns, you will most likely miss the volatility, the high volatility for this day. So the main contribution of the paper is the following. So we actually use the principal component analysis designed for high-frequency data to document the fine structure of a large cross-section of this intraday stock returns. We propose a new covariance matrix estimator using this latent structure. And the new estimator is well-conditioned, this is very important, to give reasonable portfolio allocations. So for example, if your covariance matrix is not well-conditioned, you might end up with a portfolio that allocate 100% in Apple minus 800% in Google, something like that. Okay, but our portfolio, our covariance matrix will be able to give reasonable portfolio allocations because it is well-conditioned. So it also takes advantage of the established time variation in volatility and correlation. Okay, so this sort of captures the time varying opportunities that we mentioned in the previous slides. And most importantly, it is simple. Okay, so this is actually quite important because we want our method to be used by the audience here, for example. So it has to be extremely simple and accessible to the public. So we also provide a new estimator to determine the number of latent factors, and factors and their loadings are also provided. So there are some main empirical findings I would like to summarize here. So we use PCA to identify statistical factors, and they explain more variation than the economic factors, such as the market portfolio, the 5-mile fringe factors, as well as the industrial ETF portfolios. And the residual covariance matrix, okay, which is the part that sort of after you remove the component explained by the PCA, the residual covariance matrix is very sparse and not diagonal. And the optimal portfolio based on our covariance matrix is better in terms of auto-sample performance. So here's the main idea. Okay, so first of all, I'd like to show you that why this problem is a high-dimensional problem. So even with intraday data, where I sort of, I can have a lot of observations within the day. So for example, for a typical stock that is very liquid, we have over 20,000 observations per day for a typical stock that is very liquid. So that increase the sample size for us, which is very useful to deal with the curse of dimensionality. However, so if you look at the 1 month of 15-minute returns for 500 stocks, there are about 600 observations per ticker. So the cross-sectional dimension over the time series dimension is around 1. And in this case, we know that the sample covariance matrix is yield conditioned. Okay, so we need to solve this curse of dimensionality problem, even with intraday data, if we want to have an idea about monthly volatility. So you might wonder why not sample more frequently, such as using frequency that is as high as 1 second. Well, the problem is the microstructure noise. In theory, the transaction prices should follow a random walk, or in continuous time are semi-martingale. Okay, but in reality, the transaction prices jumps back and forth between bid price and ask price. As a result, there is considerable amount of noise in the transaction level data. So therefore, we cannot use the highest frequency available. And secondly, even within these 500 stocks that are the constituents of S&P 500 index, there are still quite a lot of them that are not that liquid. Okay, so if we sample extremely high, we're not able to deal with the synchronicity problem. Okay, we're going to face this synchronicity problem, which is normally not an issue for daily data, but it's certainly a problem for intraday data. Okay, so apparently we're facing this high-dimensional problem, and we need more structure on the covariance matrix. So there are 2 types of approaches in the literature that we're aware of. So the first approach is very popular in statistics, that people make all kinds of sparsity assumptions on the covariance matrix. So for example, you could assume a bandable structure or tuple structures, stuff like that, or you can simply assume there is a small number of non-zero entries. Or you can impose such assumptions on the inverse of the covariance matrix. So alternatively, economists would like to use the factor model. So there are 2 types of, at least 2 types of factor models, depending on the assumptions you want to make. So the classical ones assume that the residual covariance matrix has diagonal covariance matrix, which might be a very strong assumption because factors alone may not fully explain the co-movement of asset returns. So for example, the Pepsi and Coca-Cola, they're highly correlated, not necessarily entirely due to their exposure to the common risk factors. There may be some idiosyncratic things between those 2 companies. So therefore, it is perhaps very important to think of approximate factor models which do not require a strict diagonal residual covariance matrix. So to decide the assumption that we want to make about the data, so why not let the data speak? So here, we plot the significant entries of the covariance matrix of 500 components within the S&P 500 index. So here, by economic significance, I meant that the sample correlation is larger than 0.1. Okay? So as you can see, it looks like there is a blue square here, but if you have a pretty good vision or a very good pair of glasses, you may be able to see there are some white space over there. This is not entirely a blue square. So it simply means that the sample covariance matrix is not sparse at all. Okay, so we cannot blindly make this assumption on the data. However, if we use some known economic factors, such as the market factor, so we call this model cap M, the residual covariance matrix starts to become slightly more sparse, as you can see from the left top picture. And increasingly, if I keep adding more factors, if I keep adding pharma fringe factors, the momentum factors, the industry ETFs, eventually, if you take a look at the right corner, the right bottom corner, the residual covariance matrix looks quite sparse. So it seems like the asset returns can be described in the following way, right? So it can be decomposed into the part that is explained by the factors and the residual covariance matrix, which is very sparse. We could have stopped here, but we want to move further to think about what drives those idiosyncratic covariances. So here what we did is simply first sort the stocks by their industry classification codes. So in other words, similar industries are stocks belong to the similar industries are clustered together. So in this red block, okay. So here I list four sectors here. So E is energy, CS is consumer staples, F is financial, U is utility. Okay, for example. So if I first sort the stocks by their industry classification codes and then do all the same steps that I have been doing, you can see clearly that a lot of this residual covariances can be explained by this within industry correlations, which couldn't be captured by the economic factors. So motivated by this, we're going to make an assumption. We're going to make assumption that the residual covariance matrix as a known block diagonal structure. So this will help us reduce the tuning parameters which otherwise inevitably have to be included in any thresholding procedure. So we're going to make this assumption. And eventually, the assumption we're going to make is the following. So we're going to assume the covariance matrix is made of this, is a low rank plus sparsity. So it is equal to the loading times factor covariance times the loading transpose plus a block diagonal residual covariance. And the block diagonals, the blocks are known in priori because they are, we can certainly read the classification codes. Okay, so this is basically the whole idea. So now let's sort of do some mathematics and trying to be very general about the asset dynamics. So here we assume that on the intraday returns, which is YT, the log returns, can be explained by this linear factor model, where beta is the factor loading, X is the unobserved factors, and ZT is the residual. Okay, so XT and ZT follows a standard Ito semi-martingale. So as you can see here, the assumptions we're making here is pretty general. We're not trying to, we don't have to make any assumptions about HS, eta S, FS, or gamma S. Okay, so we're trying to be agnostic about the dynamics of volatility, stochastic volatility, etc. So we essentially pose no assumptions on stationarity or heteroscedasticity. Okay, so instead of looking at the covariance, which obviously based on those assumptions we cannot even well define the covariance matrix. So we're going to focus on the quadratic covariation. Okay, so we're going to look at the realized covariance. Okay, so in our study we're going to fix the time window to be 1 day. Okay, and measure the realized covariance between between several assets within a day. Okay, so the next assumption we impose is there is orthogonality, right, between the residual and the factors. And the covariance is here is the quadratic covariation between two assets, between X and Z. So as a result, we have the key decomposition we want, which is sigma is equal to beta transpose plus gamma. So notice that sigma, E, and gamma, they both depend on time. Okay? It is only the factor loading that are required to be time invariant. Okay, so to complete the model, we need additional assumptions on the sparsity that we have talked about. So for now, for the theory part, let me start with just imposing the sparsity. So for now, we don't need any block diagonal structure. Okay, we're going to add that when we talk about estimation. As I have told you, the block diagonal thing is only useful to help us avoid tuning parameters. Okay, so for now, we only need the sparsity assumption on the residual covariance matrix, which is gamma. Okay, so assumption 3 basically says, so the number of zeros there are not too many non-zero entries in gamma. Okay, so to ensure the identification, we also need the usual pervasive assumption that you can see in the literature of vector models, in the literature of approximate vector models. Okay, so now we present the identification theorem, which is very important. Right, so that theorem tells you that given you infinite amount of data, you can perfectly estimate the sample covariance matrix. Now the question is, are you able to learn about the factor structure simply based on the sample covariance matrix? So the answer is yes, you can, but up to some noise, up to some error. Okay, so MD here, remember, is a sparsity constant. So by doing the eigen decomposition of the covariance matrix, we can actually recover the component explained by the factors, which is beta E beta transpose, as well as the residual, which is gamma, up to an error, and the error is of the rate MD over square root of D. Okay, so we can only recover beta E beta transpose and gamma. We cannot recover, obviously, there is not a unique decomposition of the covariance matrix. And this is also the so-called the blessing of dimensionality. As you can see, only when dimension is large, we can identify these two parts. Okay, only when dimension is large, we can identify the beta E beta transpose and gamma. Okay, so now the identification is clear, we can talk about estimation. So the estimation is very similar to the classical, long span time series. So we're going to define the returns, which is delta I and X, which is the intraday SRA term. And the sample covariance matrix is the usual sample covariance matrix, except that we don't really need to worry about the mean, because the mean is of a smaller order. And we can estimate certainly the eigenvalues and eigenvectors corresponding to the covariance matrix. And then, so if we're able to estimate the number of factors, we can certainly recover the residual covariance matrix, which is gamma hat. And now we're going to impose the block diagonal assumption on this residual covariance matrix. So in other words, we're doing this thresholding, and then we add back this the part that is explained by the factors. So eventually we obtain our estimator. Which is sigma hat S. So this is our new estimator for the sample covariance matrix, for the covariance matrix. So certainly we can estimate the residual covariance matrix as well. Okay, so we also have to determine the number of factors we want to use. So here our strategy is very similar to the binding strategy in the 2002 econometrica paper, except that we're not going to minimize the residual trace, or we can directly minimize the eigenvalue scaled by the dimension. And this actually is very simple, and we can avoid the theory of random matrix by doing it this way, because the theory of random matrix for semi-martingales is not known, to the best of our knowledge. Okay, let me skip this slide. Okay, so now let me talk about the asymptotic theory. So our theory is based on the dual infill and divergent dimensionality asymptotics. So divergent dimensionality simply means the cross-section of assets goes to infinity. At the same time, the infill asymptotics is slightly different from the usual long span asymptotics. So let me briefly talk about it. So the way that our sample size grow is we are actually sample the data within a fixed window more and more frequently. So this is how we think about infill asymptotics. This is how our sample size grow. Okay, so our sampling frequency goes to 0. At the same time, the dimension goes to infinity. Okay, so we can certainly have some guarantees about we are able to determine the number of factors, and we also have analysis about the accuracy, the consistency of the residual covariance matrix, the covariance matrix itself, and as you can see, the rate depends has two components. Okay, so the first part delta n log d 1/2. So d is the dimensionality. We're very happy that it's logged, but it's not surprising at all. And delta n is the sampling frequency, okay? So it is proportional to 1 over n, where n is number of observations. So this part is also not very surprising. Okay, but what I want to mention here is the first rate is basically captures the curse of dimensionality. The larger the dimension is, the larger the error is. Whereas the second term, which is md over square root of d, captures the blessings of dimensionality. Okay, it is the identification restriction that we learned from the first theorem. Okay, so it's a nice balance between the two. So this is the covariance matrix and the residual under the max norm, under the max norm. So we can also do it under the spectral norm. And more importantly, we can show that the smallest eigenvalue of this truncated of our covariance matrix in my hat S is bounded away from 0 with probability 1. So therefore, approaching 1. So therefore, our covariance matrix is well conditioned. And we can also find the rate for this, for the inverse of the covariance matrix. So our identification, by the way, is very different from, is different from the usual identification in the literature where they require the eigenvalues of the residual covariance matrix to be bounded. So we slightly generalize that to allow it to grow. The rate is MD. So we allow it to grow. So therefore, the rate is slightly different from the Euro rate you see in the literature. So finally, we can certainly estimate the factors and the loadings up to a rotation. So this is also known from the seminar paper by Serena and Bai. Okay, so let me briefly show you some simulation results and conclude with an empirical study. So here we simulate 100 sample pairs from continuous time factor model. And as you can see, we allow all kinds of stochastic volatilities and leverage effect. So here D is 500. The number of factors R is equal to 3. So we also simulate. So in addition to the price, we also simulate microstructure noise. We also simulate the asynchronicity issue, just trying to see that if we subsample our data at a very low frequency, let's say 15 minutes, are we able to ignore the noise? Are we able to ignore the asynchronicity issue? And here is the simulation results. So the columns with star on it. So REG star stands for regression. So it means that the factors are actually known. Okay, I'm using the factors. In simulations, I certainly know the factors that generated my data. And a star means there is no noise, no asynchronicity. So this is basically a very ideal case. And the PCA star means I'm using PCA without knowing the factors. There is no noise. So as you can see, the PCA star and the regression star are very close in terms of the max rate and the L2 norm. So the REG and PCA without star means that I'm applying them to the real data, okay, to the data, well, not to the real data, but to the data with noise and with asynchronicity. So certainly, because of the noise in the data, at 5 seconds, the performance is rather poor, okay? But if you subsample the data, like at 900 seconds, which is correspond to 15 minutes, the signal to noise ratio is pretty large. So we can do a pretty good job. We can do a pretty good job to be very close to the infeasible estimates. Okay, so let me talk about the data. So we'll collect the data from the tech database for intraday observations for 736 stocks. Okay, so because of the in and out of the index constituents over these 10 years. By the way, this is a pretty large data set. Well, the original data set is pretty large. It's over a terabyte. But we subsample the returns every 15 minutes. So this makes the data set considerably smaller and make our analysis much easier. We also collect the global industry classification codes, which basically tell us which stock belongs to what kind of sectors. We also make use of observable factors for comparison purpose. So we collect market portfolio. We build high-frequency version of pharma fringe factors. We also use non-industry ETFs. So this is the same plot, but I do, that I showed you before, but this time I do it for PCA components, So if I use one component, the residual covariance matrix is a mess, okay? Is a mess. But once I increase the principal components that I'm using as, to sort of explain the factors, so the residual covariance matrix become, closer to the block diagonal structure, the assumption that we made before. And as a comparison, you can see this is a result for the observable factors. So observable factors actually do a pretty good job as well. And this is a plot of the number of factors we estimate on a monthly basis from the data. So it roughly changes from 3 to a size 10. And this is an in-sample R-square that we can compare. So for one factor, if I compare the PCA versus the regression, where I use economic factors, the known factors, so they look pretty similar. They look very, very similar, okay? Because the first factor we all know is the market. So once I increase to 4, 10, and 13 factors, the PCA does slightly better. Okay, can explain more variations in the data. Okay, so finally, let me take this our covariance matrix to the data to sort of show you some empirical performance for a portfolio allocation exercise. So here we try to maintain the simplicity of this allocation exercise because we want to highlight the advantage of the covariance matrix part. Okay, so therefore we do not have any estimation or even optimization related to the expected returns. Okay, and we're using this month's realized covariance matrix as the best predictor for the next month. So we're trying to make this as simple as possible so that we can focus on the performance of the covariance matrix. So here we add exposure constraint. We're going to do portfolio allocations for a lot of different exposures. When this gamma exposure constraint is equal to 1, we have a long-only portfolio with only a handful of stocks being selected. So this is a usual thing we have seen in many lasso type of stuff. And when gamma is infinity, so this is basically the minimal variance portfolio. Okay, so this is the last picture I want to show you. So so here I want to compare this sample covariance matrix, which is this red line here, red curve here. So this is the results based on the sample covariance matrix. So here the y-axis is the annualized risk. Okay, we want it as small as possible, auto sample risk. And as you can see, so once we relax the exposure constraint, more stocks will be selected into our portfolio. So therefore, in-sample risk should be decreasing. Okay? However, the auto sample risk based on the sample covariance matrix is actually increasing dramatically. This is clear evidence of the problem of this condition. The sample covariance matrix is not well conditioned. Okay, so it's going to allocate a big chunk of wealth to Google and minus that to Apple or something like that. Okay, so it's not well conditioned. So that's why it does not perform very well as we relax the exposure constraint. However, if we use our factor-based strategy with PCA or even with regressions, so the performance is pretty stable. And the annualized risk over this period is only 6%. And for comparison, the annualized volatility of an equal weighted portfolio is about 17%. Okay, so we can certainly do better. And that's it. Thank you very much.